Many people think they are simply bad at investing because their portfolio never seems to move fast enough. But the real problem is often not the return rate or market volatility at all. The bigger issue is usually a lifestyle that quietly became too expensive to sustain long-term. So every salary increase disappears into higher fixed expenses before wealth has time to compound. In many cases, the portfolio itself is actually doing exactly what long-term investing is supposed to do. The problem is that fixed expenses often grow faster than the portfolio during the early years. That imbalance creates the exhausting feeling that you are working hard without ever making progress. In reality, many people are not failing financially because they are simply losing against their own cost structure. Welcome to The Margin, where we break down the uncomfortable math behind modern financial life. Today we explore how fixed expenses quietly destroy compounding long before compounding becomes powerful enough to notice. Internet finance content keeps arguing about which stock will outperform next year. Then another creator appears claiming a different ETF is the smartest long-term move. Crypto channels promise volatility is just the price of future opportunity. And someone always claims they've finally figured out the perfect market timing strategy. But almost nobody asks whether your monthly cost of living already consumes your future. Because that is where the real financial war quietly happens every single month. Investments usually work on a long-term time horizon measured in years. Fixed expenses operate on a completely different schedule that arrives every 30 days. Every month the money leaves your account before your portfolio even has time to recover. The system does not pause simply because your income feels stretched and exhausted. Rent keeps demanding cash regardless of market volatility or economic optimism. Car payments quietly reduce financial flexibility long before people notice the drawdown. Insurance premiums continue rising even when your salary barely moves forward. Subscription services feel harmless individually until they quietly become permanent monthly obligations. Money keeps leaving your life even during market downturns and periods of uncertainty. And that silent pressure usually shapes financial anxiety more than volatility ever does. Let's look at a simple number problem that quietly shapes most modern lives. Your investment portfolio grows 8% per year, which sounds responsible and long-term. On paper, those returns look like progress toward financial stability. But your lifestyle quietly rises 12% every year without feeling dramatic. At that point, the math quietly stops working in your favor. Your investments spend most of their time chasing the cost of your newer habits. Years ago, a salary increase used to feel like genuine financial progress. Now it often feels more like catching up with rising living costs and volatility. Modern economies are extremely good at turning luxuries into emotional necessities. Streaming subscriptions once felt like a small luxury purchase. Today they often feel as essential as electricity or internet access. Food delivery also used to be an occasional convenience during busy weeks. Now, many people order automatically without even thinking about the long-term cost. Individually, each monthly expense still looks harmless and manageable. But compounding works on repetitive spending habits just as efficiently as investments. And that invisible compounding effect is what many stressed workers never fully notice. There's actually a name for the feeling that your income keeps rising, but your life still feels financially tight. It's called margin compression, and it quietly happens long before people notice the damage. Every new salary increase gets absorbed by subscriptions, rent upgrades, and larger monthly obligations. From the outside, life looks upgraded, even when financial breathing room barely changes. The dangerous part is that your income rises, but your flexibility never grows with it. Someone earning $50,000 a year can still feel financially stuck every month. Even people earning $200,000 can quietly experience the exact same pressure. Because the real issue is rarely income alone or short-term market volatility. The real question is how expensive your current life has become to maintain every month. And the higher your fixed expenses become, the smaller your room for long-term decisions gets. Suddenly, quitting a stressful job no longer feels like a realistic option anymore. Taking risks becomes harder when every decision carries the possibility of financial drawdown. Even resting for a few months can start to feel financially irresponsible. Long-term compounding becomes difficult to focus on when survival costs dominate daily thinking. Eventually, every life decision starts passing through the same financial filter first. Can I still afford all of this next month becomes the question quietly controlling everything. Many people panic during market volatility because their financial life already feels fragile before the drawdown even begins. It is usually not a lack of belief in long-term investing that creates fear during a downturn. The real problem is that their monthly obligations leave almost no room to survive uncertainty. A 20% portfolio drawdown feels terrifying when your daily life already depends on every paycheck. But fixed expenses continue at full speed regardless of market volatility or economic headlines. Mortgage payments still arrive on schedule even during a painful bear market. Car payments also continue quietly in the background no matter what the economy is doing. Groceries still need to be purchased tomorrow morning even if the portfolio is temporarily down. This is usually the moment where financial stress quietly becomes mental pressure. Under pressure, many investors begin selling assets earlier than their original time horizon planned. Some people even pull retirement savings too early just to restore short-term cash flow stability. Others stop investing completely because survival feels more urgent than compounding returns. In many cases, the portfolio itself was never the main source of financial instability. The deeper issue was often the monthly cash flow pressure slowly draining financial resilience. Cash flow determines how long someone can survive uncertainty without abandoning their long-term strategy. Because in real life, survival almost always wins against even the smartest financial strategy. Many people spend years chasing passive income while their daily expenses quietly become more active every month. Their income becomes semi-passive over time, but their lifestyle still demands constant financial maintenance. The more successful someone looks online, the more expensive their personal system often becomes behind the scenes. A bigger house may feel like progress, but it also expands the number of fixed costs waiting every month. An expensive car is not only a purchase because it also creates recurring costs long after the excitement disappears. Lifestyle inflation often arrives quietly through subscriptions, conveniences, and routines that slowly become permanent. Every upgrade feels temporary in the moment, but the maintenance costs often become permanent. High income can improve quality of life, but it does not automatically create emotional stability or long-term flexibility. Sometimes a higher salary simply creates more polished versions of the same financial stress. This is the modern middle-class trap because appearance improves faster than financial resilience. From the outside, they appear financially secure, but internally the margin for error remains extremely small. One delayed paycheck or unexpected drawdown can quickly expose how tight the system really is. When fixed expenses stay too high, compounding loses valuable years that could have strengthened long-term stability. Money cannot compound efficiently when most of it disappears into recurring obligations before investing even begins. The larger the financial leakage becomes, the weaker the effect of volatility recovery and long-term investing. Even strong market returns struggle to help when fixed expenses absorb most of the progress before it compounds. Two people can earn the same salary and still end up living completely different lives. The first person spends every raise upgrading their lifestyle a little more each year. The second person quietly focuses on reducing fixed expenses instead of upgrading appearances. 5 years later, the difference starts becoming visible in ways nobody expected. The first person looks wealthier online but carries more invisible financial pressure underneath. The second person feels less impressive but far more stable during uncertainty and volatility. Freedom usually looks boring on the internet because calm lives rarely create dramatic content. Most real financial freedom has no luxury aesthetic attached to it. Sometimes freedom simply means not panicking during a sudden job loss or economic drawdown. It means being able to walk away from toxic work environments without your entire life collapsing. It means taking a short break from work without feeling like survival is immediately at risk. That is the real purpose of long-term investing for most ordinary people. Investing was never supposed to be a performance designed to make strangers think you are rich. Its biggest advantage is expanding the margin between your income and your survival needs. The lower your survival costs become, the stronger your negotiating power becomes against life itself. And once that margin grows large enough, your entire relationship with work, risk, and time starts changing forever. Maybe your portfolio was never the main issue because the real pressure was quietly coming from your fixed expenses all along. Sometimes the real financial upgrade is not earning more money but redesigning the structure of your everyday life. Compounding only works well when your income has enough breathing room and enough long-term time horizon to grow quietly. But fixed expenses slowly consume that space month after month before most people even notice the volatility building underneath. And the strange part is that many people never realize it until their financial flexibility has already disappeared. That is why financial freedom feels farther away today, even for people who technically earn more than before. The problem is often not a lack of income, but the rising cost required just to participate in normal modern life. Modern systems quietly train people to confuse lifestyle inflation with genuine long-term financial progress. But many of those upgrades simply create new permanent obligations that continue long after the excitement disappears. Wealth may have less to do with buying more things and more to do with reducing the amount required to feel safe. Because when your lifestyle needs become smaller, your risk exposure and financial stress often shrink with them. And that is usually when compounding finally gains enough space to start working in the background without constant interruption. Over long time horizons, that quiet stability often matters more than chasing perfect investments or perfect market timing. But simple long-term habits rarely go viral because they do not create excitement or instant emotional reactions online. Most platforms reward emotional volatility while quiet consistency tends to remain invisible to the algorithm. And that may be why the most effective financial solutions often look surprisingly ordinary from the outside. Many people spend years optimizing their portfolio while their monthly expenses quietly grow in the background. But very few people ask whether their lifestyle still makes sense for their long-term time horizon. Fixed expenses decide how much volatility your life can absorb before stress starts taking over. And modern financial pressure rarely arrives all at once because it now shows up quietly every single month. So the best investment is not always the highest return, but sometimes a lifestyle with lower financial drag. Because a life that costs less to maintain gives compounding more room to actually work over time. And the smaller your monthly burden becomes, the more flexibility your future quietly gains. Maybe realistic wealth today is simply having enough margin to stay calm during uncertainty and drawdowns. Subscribe to The Margin if you enjoy calm finance stories that focus more on systems than motivation. Because sometimes the real problem is not the portfolio itself, but the rising price of maintaining modern life.